Good afternoon, everybody, and welcome to the session. We are on time. We have an on-time start at 2:45. Yoni Jakes is in the room and he's ready to go. So just sit tight momentarily. We've got the last session just ending, and folks are starting to pile in now. So just sit tight. We're going to get started at 2:45 Eastern Time. Thanks so much for joining the session with us. Hi, good afternoon, everybody, and thanks for joining the session. Yoni, our speaker, is in the room. We are ready for an on-time start at 2:45 Eastern. So literally just sit tight for another minute or two, and we will get started momentarily. Thanks again for joining. Good afternoon, everybody, and thank you for joining the session. A couple of bits of housekeeping. We'll get right into Yoni's presentation. First, we want to thank everybody for participating in the virtual shows and, of course, the live events we're producing throughout the year. Keep that feedback coming. It makes us better and better as we move forward. Secondly, depending on time, we're going to try to answer a question or two. Maybe not, but maybe we will. There is an interactive chat box next to the player where you're watching Yoni present right now. If you have any questions, whether it's technical or what have you, shoot those questions over and I'll try to answer as many as we can as we move forward. But with that said, it's my great pleasure to introduce to everybody Yoni Jacobs, who is the Chief Investment Officer at FinViz, where he focuses on stock market research and developing new tools and features for investors and traders. And his over 20 years of investment experience encompass hedge funds, wealth management, including roles as an analyst, portfolio manager, and a strategist. Yoni, it's great to have you with us here at the Money Show. We appreciate you, sir, and the floor is now yours.
Great. Thank you, Joe. Hello, everyone. Welcome to the Money Show. Today, I will show you how to find great stock picks, how to find yield, quality, and value by applying the fixed income approach to the stock market. My name is Yoni Jacobs. I'm the CIO, Chief Investment Officer of Finviz.com. What if you invested in stocks with the mindset of a bond investor? Bond investors care about four things. They want safety, income, quality, and value. I'm going to show you today how to filter, how to screen for those ideas, and how to look at the entire market, the S&P 500, Russell 2000, NASDAQ 100. We have 10,000 stocks on FinViz, and you can screen through all of those companies to find only those top stocks that meet your criteria. So what if we used these bond investor requirements of quality, yield, safety, and value, and we apply that to the stock market? If you haven't heard of FinViz, we're a top player in stock market analysis tools. We have charts, commodities, heat maps, energy, gold, news, fundamental data. We have the #1 stock screener and the #1 heat map that I'll show you today. You can see our heat map almost every single day on CBS News. Millions of users use FinViz every single month. Whether you're a day trader, a long-term investor, a retail private investor, an institution, hedge fund trader, wealth manager, student, right? Whatever your style is, FinViz can help you make smarter, data-driven decisions. Okay, so what are we looking for today? We want to think like a bond investor. We want to look for yield, safety, quality, and value. So if we apply that to the stock market, let's compare the fixed income versus equities, bonds versus stocks. Bond investors, when they think of yield, they're looking for a coupon. What's the current yield? What am I getting as income on my bond investment? If we apply that to equities or stocks, it's not just about total return. Of course, we want to make a lot of returns, but we also care about income and yield, so we can look at dividends. Quality, a bond investor is thinking about credit rating. Is it AAA rated? Is it high yield junk bond? Right? The better the rating, the higher the quality, hopefully. And they're also looking at cash flow. Does this company have strong cash flows? On the equity side, we're looking for growth, profitability, EPS, earnings per share. When it comes to quality, we really want stability, consistency, and reliability. And then, of course, safety, right? None of us want to lose money when we invest. So safety is a major consideration. In the bond world, we're looking at leverage. We want to make sure there's not too much debt, and we want interest coverage. We want to make sure that the issuer of the bond is able to pay the interest that it owes. In the equity market, we're looking at debt ratios and liquidity. We want solvency and a strong balance sheet. We want manageable debt, and we want liquidity available to run the business. Okay, and then finally for value, right? Value means we want to buy things either cheap or at a fair price. We don't want to chase things that are completely overvalued. So for the bond investor, you might look at a discount to par. Is this bond selling at a discount, which would affect maybe my yield to maturity? If I buy a 5% bond, but I buy it at a discount, my yield is going to be higher by holding it till maturity. On the equity side, we're looking at valuation multiples, things like price to earnings, price to book, price to cash flow, EV to EBITDA. Okay, we'll talk all about these valuations, but that is one way that stock investors can narrow down the list. So where do we find these companies, these high quality companies that we're talking about? Well, there is no question, it is clear to see that the market for the last 10 years has been carried by technology. The place to be has been technology, specifically mega cap technology. The largest companies in the world are big tech names: Apple, Google, Microsoft, Nvidia, Amazon, Tesla. They dominate the market. And it's hard not to chase them when they're making 20 to 30% return a year. Just look at this 10-year performance heat map. You can see the S&P 500 companies, all 500 companies, and their performance over the last 10 years. And it's clear to see that the mega cap technology companies have been the best performers. Nvidia is up 26,000% in the last 10 years. And of course, it is almost impossible for that to repeat over the next 10 years. But still, some of the top companies, stable companies that we all know, Microsoft, Apple, Google, Amazon, they're all up at least 500% over the last 10 years. That's a 50% annualized return. Okay, so it's hard to argue against technology, but dominance comes with a price. Today, the top 10 companies in the S&P 500 make up nearly 40% of the index, and that's an extreme level of concentration. Nvidia alone has the same weighting as the bottom 224 companies. And it's hard to bet against Nvidia, especially with earnings coming out this week. But let me ask you, would you rather bet on Nvidia continuing to be perfect or bet on the entire group of up-and-comers? Personally, I would pick the other 224 companies because the next Nvidia could be one of those companies. I think there's more growth in the other, but that's up to you. We'll find out. Okay, so even though technology has been the winner for the last 10 years and it's hard to argue against it, long term, you have to stay diversified. You have to put money in other sectors, right? What about financials, healthcare, energy, industrials, consumer defensive? There's definitely other places to put your money that will improve your returns or lower your risk. Okay, long-term investors, the smart investors, you have to have a diversified portfolio. You can't put all your money in technology. We've all heard, the famous line we all know, don't put all your eggs in one basket. And this might sound pathetic or so basic and so obvious, yet the majority of investors are not diversified properly. A simple analogy: if you own a sunglasses company, Company A, and you're trying to diversify or hedge your portfolio, should you buy Company B that sells ice cream or Company C that sells umbrellas? Okay, Company A and Company B will do very well on hot and sunny summer days. But what about during cold and rainy days? To properly diversify, you have to invest in Company C, because the main point of diversification is that you buy companies that move differently. You can't have the companies move exactly the same, or you'll have a lot of volatility and underperformance during certain seasons or cycles. So you want low or negative correlation to each other. And by the way, some of these slides are from Training the Street, a company that I teach for, a top Wall Street training firm. If anyone wants financial modeling, valuation, Excel, LBO, M&A training, we're known around Wall Street. Feel free to check us out. Okay, but we want diversification. Why is it so important? Because there are other places to put your money that will lower your portfolio volatility. It will make your portfolio less risky. And theoretically, the returns will be greater. You'll have a higher risk-adjusted return. You're going to be able to invest your money for the long term and let your investments compound over time. Really, the goal is to grow your money in the long term. And when I was at Merrill Lynch, Bank of America, I got to see what the wealthy investors are doing. Most successful investors hold things for a long time. They let their winners continue to run, continue to win, right? We might all want to be more active in the stock market, make really strong stock picks, but buy and hold does tend to work, especially since 2009. We've all seen it. Warren Buffett himself picks a couple of companies that he truly believes in, and he makes those a big part of his portfolio. He invests in high-quality businesses that he could own for the long term. Okay, and there's a reason why Warren Buffett is maybe the greatest investor of all time, right? He knows how to pick quality, safe companies at a cheap valuation, or at a fair valuation. And you can see his portfolio here. Coca-Cola, Bank of America, American Express, Apple, Chevron. Not only does he know how to pick stocks that will win, hopefully in the long term, but even though he is A little bit against complete diversification. He's still pretty diversified when you look at his portfolio. Coca-Cola, consumer staples, Bank of America, financials, Apple, technology, Chevron, energy. So he still is pretty diversified. And what I strongly recommend that any long-term portfolio should have a significant percentage of core positions in safe dividend-paying companies. You can think of this as a core satellite approach. The majority of your long-term investments should be in a core approach, where either ETFs, index funds, overall market, but as well as today, the safe dividend-paying companies that we're going to be talking about. The goal of the core is that you leave it for the long term and it's pretty safe and stable. With the satellites, you can put other investment strategies in there. You can be more tactical, you can be more specific, you can be more active, but you can go for a home run, but not with the majority of your money, which is the core. So how do we find these great companies that Warren Buffett would even agree that we should buy? How can we learn from him and find those companies? Let me show you the Finviz heat map. This is the S&P 500. It's the most popular heat map we have. Here you'll see the top 500 companies in the US. It shows you how much they're up or down. The size of the box is proportional to the size of the company or the market cap. Okay, so you can clearly see the mega cap technology names that we all know. They're the biggest for a reason because they're the largest companies. This is also sorted by sector and industry. So you'll see technology up at the top, financials, healthcare, there's energy and consumer staples. This is the quickest way to see all the stocks and how they're performing over a certain time period, whether it's live today or other time periods. It's a quick way to see the winners and the losers, which sectors are performing well. If you're a day trader, you might look at the 1 minute, the 15 minute, the 30 minute. If you're a long-term investor, you might look at the 1 year, 5 year, or 10-year performance. Maybe the best one to look at is the 1 day, what's going on live right now in the market. Or you can look as well at year to date. How are the stocks performing so far this year? You can look at the S&P 500, or you can look at other major indices like the NASDAQ 100 or the Russell 2000 that you'll see right here. These are the 2,000 small cap companies. If you're looking for home runs, maybe some bigger gains, small cap is maybe a place to look, even though it hasn't been performing as well as technology, but definitely a good place to look. You can look at the futures heat map, the macro view, the big picture. It's not just about the stock market, but other asset classes as well, like commodities, bonds, currencies, gold. If you want to predict where interest rates are going, where the bond market's going, where stocks are going, it helps to understand other asset classes. Okay, from the futures, you can look at the world heat map. This will show you the top stocks from around the world that are listed on US exchanges. Okay, you could also look at the ETF heat map. This is the top ETFs that are traded in the market. You can track the sectors. You can track US versus international. How's emerging markets doing? How's other countries doing? You can look at commodities. You can compare small cap versus large cap. And we even dedicated a big portion of this map to fixed income. What's going on in the bond market? Treasuries, high yield, junk bonds, broad bond market, municipals. Where's the money flowing? What's starting to move? This is one place to look. Okay, maybe not as relevant for most of us, but we also have a crypto heat map. You want to see Bitcoin against the top altcoins? Look at the crypto heat map. We have a day trading heat map. You want to see high volume, high relative volume, spot unusual activity? Use the day trading heat map. We also have an earnings heat map. You can see all the companies in the S&P and other sectors and when they're reporting their earnings. This way you can be prepared and not shocked when your company reports earnings. Okay, now that we understand how heat maps work, what are we here to do? We're here to find that yield, safety, quality, and value. So let's get started. The first is we want yield. We can look at those dividends. We want high income. So here's the S&P 500. Who's paying the high dividends? Well, it's not the technology companies. It's not Meta, Google, Apple, Microsoft, Nvidia. Those are paying really small dividends. Amazon and Tesla are not even paying dividends. So if you want high dividends, you need to look elsewhere in the market. There's Verizon, almost 7%, AT&T, Coke and Pepsi, McDonald's, Home Depot. There's the healthcare companies, there's financials, there's energy, ExxonMobil, Chevron. Okay, they all have high dividends. So this might be a great investment opportunity, not only to diversify, but to get that income. Okay, but a high dividend is not enough. Just because a company pays a high dividend doesn't mean that they can actually afford and continue to pay that dividend for the next 10 years. We want companies that are sustainable. Okay, so how do we filter this down? We got some nice looking dividends here, but we have to filter this further. Okay, so next move is we're going to look at quality. Quality means strong fundamentals. We want companies that are growing sales, growing earnings per share, EPS, and they're profitable. It's not enough just to grow the sales or the top line, right? We can look at sales quarter over quarter, trailing 12 months over the last year, the past 3 or 5 years, right? And have you heard of top line, bottom line? If you watch CNBC, they always say, did the company beat on the top line or beat on the bottom line? The top line is sales before any expenses, and the bottom line is net income. That's the income statement. Okay, so we want to make sure a company is growing on the top line, but we also want to make sure they're profitable. So one measure of profit is earnings per share. That's the net income divided amongst the shareholders. Okay, and maybe the number one driver of stock prices is what happens to EPS. So you can sort by EPS, trailing 12 months, and other time periods. You can see Tesla for the last 12 months has not been performing well in terms of earnings per share, but the other technology companies doing pretty well. Okay, but it's not only about EPS. We also want the company to be profitable. So we're going to look at margins. There's gross margin, operating margin, and net margin. Okay, and to me, the most important one is operating margin. I want to make sure that a company is profitable from its core business. Okay, operating income or operating margin starts with sales, takes out cost of goods sold, overhead expenses, wages, and marketing. And if a company can't generate a profit from its core business, it's going to be in big trouble. So I want to make sure that my company that I'm invested in is operating at a profit. Same thing with net income. We generally want that net income to be positive so EPS is positive and the company can grow. Of course, we all know startups and rapidly growing companies, they're operating at a loss because they're investing back into the business. So you can definitely find some great winners by being okay with negative operating margin, right? Amazon was operating at a loss for a long time, and now it's one of the biggest companies. Okay, unfortunately, that's not what we're here for today. We're not looking at companies that are operating at a loss. We're looking for quality companies that are already profitable and consistent. Let's stick with the quality companies that have proven themselves. Okay, so we're looking for positive margins, profitable companies that pay a nice dividend. And so we have yield and quality so far. How about safety and value? We want to buy safe companies that won't go bankrupt, and we want to buy it cheap. So let's do value first. Usually that's my starting point. Valuation multiples. Okay, valuation multiples is a measure of how expensive a stock is. Maybe the most popular is the PE ratio. How much am I willing to pay today for the earnings of a company, right? Either the earnings that just happened or the earnings that's going to happen in the future. That's the forward PE. Okay, and if a company is growing, investors are optimistic and excited about the company. They're going to pay high multiples of earnings. Think of it this way. A company is earning $1 million this year. You won't be able to buy the company for $1 million valuation, right? Because investors are expecting that $1 million to repeat itself next year, the following year. Not only that, we expect $1 million in earnings to grow over time. So that multiple might be okay. If investors are very excited, they're going to be paying very high multiples for those stocks. Just look at Tesla and Palantir. Investors are very excited about those companies, and they're paying 199 times or 194 times earnings to own those stocks. Okay, same thing with mega cap. Maybe not as extreme, but they're all near 30. And we live, as you can see, a lot of red on this chart. We live in an expensive time, maybe overvaluation across the market. We're so much so that even Walmart and Costco, that we would assume would have stable valuations, something more reasonable, even that they are a little overvalued potentially. There are pockets of green, right? Verizon, AT&T, Ford, some healthcare companies. There are definitely some pockets of low PE ratios, but you have to ask yourself, why are they low? Are investors really pessimistic for a reason? Maybe these companies are not performing well. Maybe earnings are going to slow down in the future. Maybe they have too much debt. Okay, so just because something has a low PE doesn't mean it's a great buy either. But at the very least, I want to filter out companies that are just too expensive. I generally don't want to buy companies that are PE over 30 or 40. That's already getting too high for me. Okay, so that's valuation. We want to buy something at a pretty good value. Investment bankers, they don't just look at PE ratios, they're looking at EV to EBITDA, enterprise value to EBITDA. And enterprise value doesn't just take into account the market cap or equity value of a stock, takes into account the entire capital structure, the debt included. It's not just about equity. We want to know with the debt included as well. And finally, we have to pay attention to a company's risk level. Okay, so if we want to pay attention to the company's risk, we want to avoid companies that might go bankrupt or will have financial problems. We don't want solvency issues. We want strong balance sheets. So one way to judge a balance sheet is to make sure there's not too much leverage or debt. And if you look over here, this is the debt to equity ratio. We want to make sure that there's not that much debt compared to the equity. And you can see, even though these mega cap tech, they might have a bunch of debt, it's not that much compared to the rest of their balance sheet. Maybe Apple is getting a little extended, and especially Oracle is getting into some dangerous territory potentially. But this is one way to take a look at it. You can see AT&T and Verizon, they both had pretty low PEs, pretty decent dividends, but they also have high debt. So maybe that is the reason why they have such low PE ratios. Okay, but debt to equity is the main one that we would look at. You can also look at current ratio. This is current assets divided by current liabilities. We want to make sure that our current assets of the company are greater than the liabilities so that the company is liquid, it can run its business properly. So current ratio, you can look at the heat map for that as well. Okay, so now that we understand all the heat maps and all the criteria, and we got a quick overview of the whole market and what we're looking for, now we can finally filter based on all those criteria. So we're going to go to the stock screener. FinViz is known for its stock screener. We have 10,000 stocks on our website. And the goal is, let's take those 10,000 stocks and filter them down to our finalists. So I'm going to open up. It's going to be a live demo. Let's get started. So I'm going to FinViz homepage. From the homepage, I'm going to click on screener. Okay, the screener has 10,000 stocks available. And up at the top here is all the filters and the criteria that we get to choose to filter down the list. You have descriptive criteria, fundamentals, technicals, etc. You can even click on all to see all the criteria in one location. Okay, but let's start filtering for that yield, quality, safety, and value. First, you might look at the index. Do we want only S&P 500 companies or other indices? For now, let's go with any. If you wanted, you can sort by sector, or you can filter by sector. You can filter only specific industries. You can filter out any countries you don't want or only countries you do want. Because this is not just the S&P 500, it might make sense to filter out the really small penny stocks or small companies that, especially today, we're looking for long-term value plays that are safe and proven. So generally, we're not going to go at a market cap that's too small. So let's go with small cap, anything over $300 million market cap. You could also do a price criteria if you only want stocks, no penny stocks, for example. Okay, and that takes care of the size at least. Next, we want dividend yield. Okay, we're up to yield, that income that we want. So here you could choose, we're going to do over 3%. I want only companies that pay at least the 3% dividend. You could do 2% and hope that the company grows. For example, a lot of the financials, Bank of America, I've liked for a long time. They are increasing their dividends over time. They're really strong financially. So you could have a smaller dividend that you hope will grow. But let's do 3% because we do want that income. Okay, next, I'm going to go to the fundamental criteria. Here we said, let's go to valuation since it's at the top here. Valuation for forward PE, I don't want to pay too much or too expensive. So I want my forward PE to be under 30. We're already down from 10,000 stocks to 665. So we're definitely cutting down the list. Next, I want price to book. right? I generally want price to book to be as close to 1 as possible, but of course, it's very hard to find nowadays. So let's do under 5 just to exclude those extreme price to books. Okay. Next thing I want is let's do some quality. What do we say for quality? We want growth. So I want EPS growth. I want my earnings per share. You could look 3-year growth, 5-year growth. What I want to do is positive growth. I just want to make sure that the company is increase its earnings over the last 12 months, at least over the short term. I want to make sure there's some short-term momentum. This is not a company that's slowing down. I want to do the same thing with sales growth. I want the top line to be growing. Sales growth of trailing 12 months, I want that to be positive. We're already down to 200 finalists. Next thing, maybe I want current ratio. We want a healthy balance sheet with current assets being greater than current liabilities. So let's do over 1. We want that current assets to be greater than the current liabilities. So over 1, we're already down to 78. Okay. With quality, we also wanted profitability and strong margins. You could be more selective here. I just want positive operating margin and positive net profit margin or net income margin. Okay, I want those to be positive. And next, I also want my debt to equity ratio to be manageable. I don't want debt to equity to be more than 1. So let's do under 1. All right. So that took care of safety. We took care of quality. We took care of yield, quality, safety. I think we got almost everything here. Okay, so we're down to 49 companies here. 49 finalists. What you could do, I could make this a little more restrictive. My goal here today is not to be so restrictive that you only get 5 results, but you might be missing on some other good ones. So it's up to you to maybe look at this list of finalists and narrow down for yourself, maybe come up with other criteria. You can add, for example, technicals. I want the stock to be trading above the 200-day moving average. But let's take a look at least at the initial list and maybe we'll narrow it down just a little bit. Here you can click on valuation. If you want to analyze your results further, you can click on valuation. This will show you all the multiples, price to earnings, forward PE, price to sales, price to book, price to free cash flow. It shows you the earnings per share and the sales growth. What I like to do is sort this. Descending market cap. I want to see the largest companies show up at the top. So just based on initial glance, we got Merck, which, by the way, this came up the last couple of days as a result, and Merck is up pretty big today, and it looks pretty good. They got some, I think, clinical phase 3 trial that was approved, right? You got Pfizer. I can't speak to all of these companies, but there's definitely some good quality here. You have low PE ratios. You can sort it by price to free cash flow. For example, I want low price to free cash flow. You can sort it by price to book. I want low price to book, right? So this is how you can filter this a little further. Or I can look at financial. I want to sort this by the highest dividend, right? So maybe I want companies with the highest dividend. I will warn you though, just because this company shows up doesn't mean that that dividend is sustainable. For example, Pilgrim's Pride, this was a special dividend. So I don't know if we can rely on an 18% dividend going forward. But this does give you a nice list to start filtering down. If we want to do one final filter to maybe get it down a little further, I want dividend growth. I want to make sure that this dividend is growing at least over the last 3 years. It's positive. So we're down to 32 companies. And then maybe we want a sustainable dividend. If a company is paying too much of its money into dividend, it's potentially going to be in trouble. That's what the payout ratio is. The payout ratio is taking what percent of your net income is being paid in dividends. So I want my payout ratio to be manageable. I don't want it to be over, let's say 60%. No, payout ratio, we want it to be under 60%. I don't want companies that are paying way too much dividends. So just like that, we got a final list of 15. Okay, as you can see, maybe we filtered out some companies that you would have wanted to include in there, but this is definitely one approach. So I would definitely recommend all these filters. Okay, so just to recap, we talked about what bond investors are looking for. We applied it to the stock market. We found out what it takes to find yield, safety, quality, and value. And then we narrowed down all the stocks to a list of the top choices that we can potentially own for the long term, let it accumulate over time, let it compound, get those dividends. Hopefully, these are safe companies that we can own for the long term. So that's how we think like a bond investor when it comes to the stock market. If anyone is interested, please contact me on LinkedIn. I'd be happy to give you at least a month free on FinViz Elite. Would love to hear from you, so feel free to connect with me. And I want to thank The Money Show. Thank you so much for having us on. And thanks to all of you for participating today and for taking part. Have a wonderful day, everybody.
Yoni, thank you very much. Great educational, great session. Obviously, we'll make a recording of this and get it over to you, but we want to thank everybody for participating in today's session. We want to wish everybody a good rest of your day and a good rest of your week. Yoni, thank you again for doing this for us, and we hope to have you back soon.
Thank you, Joe.
Thank you, guys. Everybody enjoy your week. Have a good day, everybody. Bye now.